a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. AI spending jitters. Stocks tumble as Alphabet's boost in cap spending targets levels leaves investors unsettled. Those concerns now playing out at Tesla with the firm's first cash burn in 2 years. Intel results up next. And mounting supply risks. Oil extends its rally as Houthis target ships in the Red Sea, and the US and Iran continue exchanging strikes. Let's get a check on markets around the world now. We'll start with Winnie in Hong Kong for the latest from Asia. Winnie.
Good morning, Bonnie. It's actually quite interesting to see that divergence when it comes to the reaction towards Alphabet's spending plans, especially between the US and Asia. At least here in our region, there seems to be a bit more excitement towards how the spending plans can potentially be able to trickle down into benefiting the supply chain here in the region. We are seeing SK Hynix here leading gains in Asia, given that more than 7% of its revenue actually comes from Alphabet. And we're also seeing gains when it comes to Japanese equipment makers, given that they also would benefit from this supply chain. Now, flip the board and take a look at the broader Asia market. We are seeing MSCI Asia here extending gains for a third day. It's the longest of such streak in about a month. Leading gains today, we have South Korea's Kospi Index. We are seeing foreign investors stepping in to buy, and that is also helping the Korean won to outperform the broader Asian peers. Now, also supporting the Korean won, we have tailwinds from the better than expected GDP numbers that is boosting bets for a rate hike. When it comes to Japanese yen, on the contrary, we are seeing that continue to weaken past that 163 level against the dollar.
Winnie, thank you so much. Winnie Su there in Hong Kong. Now for a look at Europe, and we'll start again with Brent because we're above $97 a barrel now, continuing to creep ever higher. The Houthis have formally opened a second front in the war. They had stopped disrupting shipping way back in May of last year, and now that has restarted again. So it's definitely putting pressure on crude. European gas futures too, holding at the 62 euros per megawatt hour level. Storage had been depleted and is restocking very, very slowly at the moment. We're only just about 50% on storage at this time of the year. You would normally be at about 70%. And the 2-year yield up about 4 basis points. They're up across the board, across Europe. In the UK, though, we are getting some policies from the new leadership. So we had the new Chancellor, John Healey, speaking at Bloomberg World Headquarters in London, in fact, and talking about fiscal responsibility. He wants to bring fiscal credibility back to these markets and to the UK picture, but also cutting taxes. So, for example, 20% tax cut for many hospitality businesses. You see the stocks Europe 600 lower today. This is, of course, a follow-on from the chip story, but also earnings just generally in Europe, putting a little bit of a downspin on markets across the region. Waiting on the ECB, of course, the euro holding water around 114.13 and gold coming off just a little bit. Let's take a look at the US picture because we're down, but not as much as we were. In fact, we've come back quite substantially since an hour or two ago. Nasdaq futures are pointed lower. We'll see how the tech trade changes that today. And then if we flip up the boards and look at yields, we're still elevated. We had a 20-year auction yesterday that had the highest yield, the second highest yield since its reopening in 2020, and you can see that fear magnified really across yields today. The 2-year yield is at 4.31, really pricing in the potential for a rate hike and two by early next year, and that 30-year yield is at 5.16 and change at this point. Now it's been above 5% for 27 days this year. Let's get to some individual market movers now. For that, we'll go back over to London and Chloe Melly.
Good morning, Bonnie. We've got Alphabet shares in the red this morning in pre-market trading as higher AI spending is overshadowing what was otherwise a pretty strong print. And so we have got this CapEx outlook coming in ahead of expectations and really fueling those investor fears around just how much those hyperscalers are spending on AI and whether those huge investments are still justified. We've got a very similar story actually for Tesla, which is also in the red this morning in pre-market trading. We are down more than 5% as this higher spending on physical AI is eating into profits and could take a while to actually translate into a meaningful revenue and earnings, according to some analysts. So we're seeing some weakness there as well. And finally, the casino operator Las Vegas Sands is also down this morning after missing analyst estimates. Now we're back up, but it was down earlier after missing analyst estimates and blaming the World Cup and the interest in the World Cup for those fewer visits at casinos. And so we were down, now we're slightly up this morning for the casino operator.
Ripple effects that you wouldn't even think of. Chloe, thank you so much. Chloe Melly there in London. She'll be back later in the hour. And also coming up this hour, we'll speak with Stephanie Roth of Wolfe Research on the Fed's rate path and, of course, this morning's ECB announcements. Shares of Alphabet lower after it increased its spending forecast to as much as $205 billion this year, renewing investor concerns about the cost of AI. Joining us now is Matt Bloxham of Bloomberg Intelligence. We were anticipating this, Matt. Would the market have been disappointed either way if it hadn't, or indeed, as we saw, it did?
Yeah, probably. The market does seem pretty fickle right now, particularly on the AI story. Yeah, and I think as much as this was anticipated, I think the disappointment to some degree is that there wasn't a more robust beat on the revenue side to kind of go with it. And so I think you're kind of getting a growing disconnect or anxiety about the visibility of the return on that investment. And the company talked in kind of broad terms around this, but I think it kind of left people with a lot of unanswered questions. And I think obviously the revenue growth was good, particularly in the cloud business. The ad sales business was a bit soft. I think perhaps where some of the disappointment may have been was in the growth in the order book, the pipeline of incremental demand they've got coming through, which grew quarter on quarter, but not spectacularly so. And I think so that kind of leaves this bigger disconnect between how quickly they can generate a return on that incremental capital spending, and will it be a big enough return?
And then, of course, we have IBM and ST Micro both cutting their outlook, Matt.
That's right. So I think the IBM cut was largely anticipated, and this reflects lower demand for their mainframe computers in the second quarter, with the company saying that clients are basically temporarily shifting their budgets to other technology. So I think the market remains unsure about how quickly, if at all, that demand is going to come back. STM, I think, spooked people quite a bit more. The Q3 revenue guide was below market expectations, but I think more than that, the profitability they announced for Q2 was much softer than expected. So I think that combination was really what's kind of taken the heat out of those shares.
Yeah, it's a very strange earnings season so far. I guess we'll see what the other hyperscalers say, and also the software makers. Matt, can I ask you also about these OpenAI models that are spending hours on hacking something that usually takes weeks? Is this something that, we should be not surprised by because that's what AI does, or is it troubling?
Yeah, I don't think we should be surprised because, as you said, that is the whole point of AI. But I think it is troubling because it does take the whole cybersecurity domain into a completely new level, and is going to make demands of companies that they're perhaps not prepared or capable of matching right now. I think what was also interesting was some of the comments we heard today from Hugging Face about the extent they had to go to defend against this attack. They tried their traditional AI models, but the guardrails that are in place to prevent those from getting involved in cybersecurity limited their effectiveness. So they had to divert to a Chinese model to kind of help them manage the attack. And I think that's going to be concerning to the US administration.
All right, Matt, thank you so much. Matt Bloxham there of Bloomberg Intelligence. Supply risks rising as geopolitical tensions mount and oil continues its rally. The Houthis say they targeted 2 Saudi Arabian flagged oil tankers in the Red Sea, opening a whole new front in the war. U.S. Secretary of State Marco Rubio telling reporters this morning that he hopes the Houthis will stop. Rubio also saying that Iran is, quote, begging the U.S. to make a deal as the sides exchange a 12th day of strikes. Bloomberg's Owner Ant joins us from Dubai. Well, I think we can hope that the Houthis stop, Owner, but why should they? What's in it for them to stop at this point? They've restarted something that was dormant for more than a year.
That's true. Yes, that's what Secretary of State Marco Rubio said, but there's no reason to believe why they would suddenly stop just because the U.S. would like them to do so. Their attack on Saudi tankers earlier today were the first that they carried out since at least May of last year, which is when they brought their broader attacks on shipping in Red Sea. to an end after starting them more than a year before that, after the Israeli campaign on Gaza. This is especially important because it practically puts at risk exports from an alternative route out of the region that we saw emerged after the Strait of Hormuz came to a standstill following the US and Israeli attacks on Iran in February 2026. And it especially puts at risk Saudi crude exports from the region, because Red Sea ports, especially Yanbu, is where Saudi Arabia was diverting most of its crude oil exports, which reached about 4.5 million barrels a day on average in June, which was the highest on record. After what happened overnight into Thursday, it remains to be seen whether Saudi Arabia will continue or will be able to continue to export via the Red Sea, but it looks increasingly difficult given what the Houthis have done.
And then, of course, there's this nuclear deal that the US and Saudi are coming to terms with. Is there a concern that Saudi will enrich uranium?
Yes, there is indeed, and that's the gist of, or that's at the heart of the criticism that this deal is facing, especially in the US on Capitol Hill. According to the Wall Street Journal earlier this week, this deal could allow Saudi Arabia to enrich uranium domestically. That's problematic for a couple of reasons as far as US lawmakers are concerned. One, obviously, the primary objective of the war in Iran was to prevent the Islamic Republic from developing a nuclear weapon. Now, allowing another country in the Middle East to have domestic nuclear enrichment, that kind of becomes or risks becoming an inconsistent policy step. And secondly, at least according to US lawmakers, is that if the US goes down this road and allows a country in the Middle East to enrich uranium domestically, then it will or it could spur a race for similar deals by other countries in the region, and eventually a race for nuclear proliferation, which is what is causing concern among US senators.
All right, Owner, thank you so much. That is Bloomberg's Owner Ant in Dubai. In Washington, D.C., Bloomberg learning that the Trump administration and its allies are discussing whether a review of the failure of Silicon Valley Bank in 2023 could provide a legal basis to remove Fed Governor Michael Barr from the central bank's board. Let's get more with Bloomberg's Alistair Bull. So a new front in the Fed war as well, it would appear, Alistair. I mean, Michael Barr stepped down from his role as Vice Chair for Supervision precisely because he didn't want to butt heads with the administration, but it seems that wasn't enough.
No, well, I think we'd been warned in advance that the Trump administration was looking at other ways of getting governors off the board. Now, the Supreme Court ruling a few weeks ago seemed to raise the threshold for removing somebody for cause. And it looks like from our reporting that they're now examining the Barr situation around SVB to see if that provides sufficient runway for them to take a go at having him removed. Now, there's two things going on here. There's can they win in court, or can they just through attrition make his life so miserable that he'll consider resigning? Vonnie.
He has serious concerns, Alistair, about the rollback of some of banking oversight, for example. Are they warranted, those concerns?
Well, it depends where you sit. I mean, from the position of the Biden administration and the Democrats, those concerns are definitely warranted because they're rolling back the Dodd-Frank regulations put in place following the collapse and the catastrophe of the 2008 financial crisis, which hurt an awful lot of people, including on Main Street. But the Trump administration has taken a more laissez-faire approach to these things, and backed by their friends in the banking industry, they're very keen to do that. And Mickey Bowman, who's now in the role of Vice Chair for Supervision, has been pushing forward. So we don't quite know where new Chair Kevin Warsh comes down on this, but I mean he's really focusing on monetary policy at the moment. But I think we sort of anticipate he's going to fall closer to the Trump administration and Mickey Bowman's vision of a slightly lighter touch around regulation. Vonnie.
Alistair, thank you so much for all that context. That is Bloomberg's Alistair Bull. Now to other top stories trending on the terminal this morning. SK Hynix has capped the amount of its South Korea listed shares that can be turned into ADRs at 2.5%. The limit is said to be fully used up already. This means investors can't turn Seoul-listed shares into ADRs unless existing ADR holders convert their US-traded receipts back into Korean shares. SK Hynix did not respond to a request for comment. BNP Paribas' second quarter results blew past analyst estimates. Its equities revenue rose 43% from a year ago to $1.6 billion. The CFO spoke to Bloomberg.
All engines are firing. The demand, probably related to the supercycle that we see, has been stronger, both in the US and in Asia, but it has been strong overall. And as we are present in all of those domains, and we have the capital, the liquidity, the leverage to do so, we are there to accompany that demand.
And UniCredit CEO Andrea Orcel provided more details on how he plans to reshape Commerzbank as he prepares to take control of the bank. This includes cutting back its international network and focusing on its home market and also Poland. Regulatory approvals for the takeover bid could come as early as the fourth quarter. Coming up, Tesla posts its first cash burn in 2 years. That's next. This is Bloomberg.
We should be spending on CapEx as fast as we can spend, as fast as we can, without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time.
Tesla taking a hit in pre-market trading as a $5.8 billion spending in the second quarter resulted in the firm's first cash burn in 2 years. For more, Bloomberg's Eric Fanner joins us now. It seems that efficient capital expenditure is the theme for earnings season, but investors didn't seem to care about that when it came to Tesla before. Why do they suddenly now, Eric?
Yeah, well, as usual with Tesla, there's a whole lot going on here in their report. I think that with the capital spending, I think the big question here is still how much of a result will it bring? He's talked a lot about, manufacturing the humanoid robots, the expansion of the cybercab business, robo-taxis, all these things, but they aren't yielding that much revenue yet. So, there's a massive amount of capital spending going on, but not necessarily delivering results that people can see. And meanwhile, there's questions about, the traditional business, the car making business, even though it had a pretty strong quarter.
So is Elon Musk concerned, and will he do something about it, or is he just not concerned about something like that?
Well, in the short term, he's spending a lot of money. They're going to have to ramp it up even more to get to the goals he's talked about, $25 billion for the year. Obviously moving toward more of an AI framework. So that means a lot more spending. He was also, he was asked about the speculation about a merger with SpaceX to, maybe fulfill some of those ambitions. Kind of danced around that a little bit. No firm comments. He said, an earnings call isn't the time to talk about that, but clearly something that he's dancing around.
Moving to Europe, Daimler has raised its outlook on an improving U.S. business climate for its truck business. What's going on here, Eric? Is the U.S. just growing much better than we expected?
Yeah, this is really all about tariffs, right? And the Trump tariffs, which hit them hard, along with a lot of the other European manufacturers of cars and trucks. The 25% tariffs there were hitting them really hard. But Daimler says they've got a favorable ruling from the U.S. on their local content rules, content inclusion in their trucks, because they do a lot of manufacturing in North America. And so that's caused them to raise a lot of the guidance on a whole series of metrics. So it's really all about that, improving their sales outlook, for the Freightliner trucks that they make.
All right, Eric, thank you so much. That is Bloomberg's Eric Fanner. Coming up, your front page news. This is Bloomberg. Is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, the New York Times reporting House Republicans won narrow approval of their $95 billion budget plan for the Iran war. The plan faces an uphill battle in the Senate, with a number of Republican senators questioning the plan's viability. Next up, the Washington Post is reporting the Trump administration is weighing military options in Mali to target an al-Qaeda-affiliated group. The group is the most well-armed militant group in West Africa. The Post says if military action is approved, it would add an 8th nation to the list of countries where President Donald Trump has ordered strikes since the start of his second term. And the Financial Times reporting that Japan's participation in a $40 billion nuclear power plant in the United States has hit a roadblock. The FT says Japan is concerned it might have to assume liability in the event of any meltdown or accident on American soil. The project was agreed on as part of Tokyo's commitment to invest $550 billion in the United States. Let's take a look at markets as we head into the Thursday session and after Alphabet earnings, also as the Houthis up the front in the war to a second territory now. Nasdaq 100 futures are lower, much off their lows of the day. The dollar index unchanged, and that 30-year yield slightly concerning. 27 days now it's been above 5% this year, and a 20-year auction was just a little weak yesterday. Coming up, Stephanie Roth of Wolfe Research on the Fed's path ahead. It's 5:30 a.m. in New York City and 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. AI spending jitters. Futures pointed a little lower now as Alphabet's boost in capital spending target leaves investors unsettled. Those concerns now playing out at Tesla with the firm's first cash burn in 2 years. Intel results up next. And mounting supply risks. Oil extending rally as Houthis targets ships in the Red Sea, and the US and Iran continue exchanging strikes. All right, let's take a look at these markets then. We're well off our lows. Nasdaq 100 futures down about 1/3%, but that was much further in the red a little bit earlier on. This even as Brent crude continues to rise. We're almost at $99 a barrel now, and WTI has cracked that $90 a barrel mark. The Houthis targeting 2 ships in the Red Sea. They'd been dormant on that front since May of 2025 after they stopped basically those attacks, which were in that case targeting Israel and its actions on Gaza. In this case, it's very clearly about something different, and they have now made the shipping situation so much worse. Let's move on to our second board because we have yields as well also creeping ever higher. The 2-year yield is now at 431.50. That's quite the extension from yesterday. The 30-year yield very close to 517, and an auction of 20-year notes yesterday which really proved there was weak demand. I also wanted to point to the yen, which continues to be firmly above 163. Let's get to some individual movers now. Here's Chloe Melly.
Good morning, Vonnie. We are seeing Alphabet shares down almost 4% this morning after the company boosted its spending target once again. And so this is, of course, fueling those investor fears, those existing fears around this AI expenditure, this potential lack of fiscal discipline from those hyperscalers when it comes to those massive AI investments. So we're seeing definitely some weakness there. We are seeing a very similar story playing out for Tesla, which is also down this morning, also in the red after missing analyst estimates, and in particular there was higher spending on physical AI, which is actually eating into profits, and analysts are saying that it might take a little while for this higher spending to actually translate into meaningful revenue and profit acceleration for the company. And finally, let's go over to one last tech stock, and that is STMicro over here in Europe. The chip maker has provided an earnings outlook for the third quarter, which was seen as a little bit disappointing. This is more due to persistent weakness in end markets like the automotive end market and the consumer electronics end market, rather than the data center business, which is actually doing very well. But we are seeing that really drag down those shares this morning. We're down more than 12% for STMicro.
All right. Chloe, thank you so much. Let's get now to our guest, Stephanie Roth of Wolfe Research on the Fed's path ahead and inflation concerns. So, Stephanie, we had thought that supply risks, particularly in the oil market, were going away, right? But now they're very firmly coming back with oil prices these high.
Yeah, I mean, so it's a challenge, especially being that we have seen some relief from the oil price. And the thing is, the inflation trajectory in the next couple of months will likely have some seasonal effects that bring it back down. The tariffs are starting to roll off. So our expectation is that even though you're seeing energy prices certainly spike, in terms of the actual feed through to core, the main thing is going to be from airfares. Otherwise, we still see some disinflationary pressures coming ahead.
So what does that mean for the Fed? Because the markets are increasingly signaling that perhaps July is not just live, but maybe advisable at this point.
I think July is still off the table. We got the really good inflation prints. There's going to be, of course, a couple of members that are likely going to be pushing for a hike. We certainly heard from Beth Hammack, Lori Logan last week. They are a lot more hawkish, but they are among the more hawkish members of the committee. So our expectation is they will set up the debate in the July meeting, and then it will depend on the path of the data through September. And it's really going to be the next two core PCE prints. Are they running somewhere below 0.25%? And then that'll allow the Fed to be even more patient beyond that. If you end up with some surprises and we're wrong on our inflation trajectory, it comes in above 0.25, then we're talking about a different scenario in September.
Well, we're looking at oil like $10 higher than it was just a few days ago. Now, that likely, well, will it have an impact on the next PCE data, or will we have to wait for a couple of months before we see that? And again, oil is something the Fed tends to typically look through, but it can't here, can it?
You know, it depends what everything else is doing. If you're seeing disinflation from some of the other components, and by the way, airfares is really one of the few things that will show it in the near term. And when you're thinking about core PC, of course, energy prices are going to show it, rather somewhat immediately. But airfares is really the component that feeds through into core PCE most, clearly. That has had an impact. Of course, it went up, and then it has recently, the gains have moderated a bit. That's really the only piece that will really be feeding into inflation. The fact that inflation is elevated today is not really related to the war. It's more related to tariffs that have had a notable impact. Our expectation is about 70 basis points on core PCE. And then on top of that, you've had AI feeding through in terms of chips. That's added about another 30 basis points. So inflation is really nearly about 100 basis points, driven by higher than what it should otherwise be, driven by factors that are not really related to the war or sort of anything tied to sort of this narrative. Therefore, those things should moderate, at least on the tariff side. So the reason that inflation is high today is much less related to the war and much more related to sort of other factors that have other nuances and may fade a bit in the future.
But you're pretty sanguine that a hike doesn't have to come in the near term, even an insurance hike. It could wait. Would it be September? Would it be beyond that?
I think it's either they go in September or they end up being able to be much more patient and don't have to go at all. September, in my mind, is the critical point in which they're going to find out if the Fed is ultimately going to have to hike or not. Because either we're in a scenario where the inflation data start to cool down a little bit, and by the way, seasonal factors tend to push down inflation in the second half versus the first half. So if we get through the September meeting and they don't have to hike, they probably don't ultimately have to hike in December either. And then by then we're probably sort of past this somewhat elevated inflation episode.
Can I talk to you about these elevated yields? Because what is the market then saying? I mean, if everything you say turns out to be true, then maybe yields don't need to be this high. And yet we've got such an amount of issuance out there. We have treasuries competing with corporate issuance and so on, that you have the 30-year yield at, above 5% for 27 days this year.
Yeah, I mean, I think buyers are just not really interested right now because risk at the moment are to the upside. That said, if rates continue to climb in the near term by probably about 10 basis points or so, I would be pounding on the table that rates are probably headed lower rather than higher. Because at some point you're going to be at a level where, one, the administration is going to be very uncomfortable with how markets are trading, and two, it becomes very asymmetric. At some point, rates are going to rise so much that it's going to create a big risk off in broad assets, and you're going to see rates come back down. So we're approaching the level where rates can't really move that much higher before there's sort of mitigating factors.
Would a broad risk-off move send rates lower? Because things haven't been that closely correlated for some time.
Yeah, they haven't. And there were times earlier at the start of the war where you had stocks selling off and rates moving higher at the same time, which is obviously not a great environment for sort of any risk manager. But at some point it becomes a problem, and rates rise too high such that it creates problems. So after we move through the big earnings week next week, the market focuses a little bit less on earnings and how solid that backdrop is. Focus may again return to rates are high. Yeah. And that could really slow down growth and cause some other problems. So I think maybe in the next week or so, we might see the stock bond correlation kind of be somewhat less correlated than normal. But I think that might return where you might be in an environment where bonds again protect you, but perhaps not in the next couple of days.
How concerned are we that Fed independence is once again at risk with this whole SVB investigation and the potential for, an attack on Michael Barr?
Yeah, I mean, certainly it's not a good thing. The markets certainly don't like when the Fed independence gets questioned. I think what we'll probably see is, however this plays out, really the decision around independence is going to come down to the path that War sets out. And he's proven to be a lot more independent than I think many expected. He's come across as much more hawkish. The market doesn't know at the moment, is he hawkish because he wants to sort of set expectations and come across as credible, or does he genuinely want to hike rates? I think he probably would prefer not to hike rates, but if he has to, he will. And I think that's going to be realistically what matters for when we're thinking and markets are thinking about, broad-based Fed independence. And, some of the stuff that happens under the surface, of course, is not great for markets and risk assets broadly. But we have seen this story before. And, courts to some extent have been sort of supportive of the Fed independence idea. So am I worried about it? Not in a big way, especially since the chair at least has set a tone that is fairly independent.
Yes. Stephanie, we know now that there is going to be a news conference. At least there was a question mark over whether he might even come out at all, Kevin Warsh, but he will come out. What will he tell us this time around? I mean, is it going to be like updates on the task forces, or are we actually going to get some guidance?
I think it's going to be updates on the task forces. I think it's going to be a lot of circularity. I don't expect to learn a whole lot about the reaction function or, what the path is going forward. I think we're going to ultimately have to rely on conversations or speeches from governors like Waller, who is, much more transparent about sharing his views about the reaction function and how the Fed is looking at the backdrop. So from Warsh, we're going to hear probably more of what we heard from last week in terms of, they're watching the data. The most recent data print doesn't make a trend necessarily unless we have more of that. Of course, there's going to be a lot of questions that are asked to him that try to poke holes at his, lack of forward guidance. But he's proven to be very good at not answering the questions he doesn't want to answer.
Yes, absolutely. Although he can't say there's a task force for that anymore. At least if he does, we know who the task force is and when they should be expected to report. Stephanie, thank you so much. Very enjoyable conversation with Stephanie Roth there of Wolfe Research. Now to other stories trending on the terminal this morning. Tesla's profit fell in the second quarter despite the strong performance of its auto business. Spending on ambitious projects such as robo-taxis and Optimus surged to $5.8 billion, resulting in Tesla's first cash burn in 2 years.
We should be spending on CapEx as fast as we can spend, as fast as we can, without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time.
Uber cutting 10% of jobs in its customer service operations as it pushes to simplify the business and expand its use of AI. Employees who'd been working remotely were also asked to relocate to a hub office. The move is consistent with the company's return to office mandate. SK Hynix capped the amount of its South Korea listed shares that can be turned into ADRs at 2.5%, and the limit is said to be fully used up. It means investors cannot turn Seoul listed shares into ADRs unless existing ADR holders convert their US traded receipts back into Korean shares. SK Hynix didn't respond to a request for comment. Coming up, the Houthis attack, escalating tensions around the Iran war. More on that next. This is Bloomberg.
Iran is begging us, okay, both directly and indirectly. Let's do a deal. Let's talk. Iran is begging every day. The problem with Iran is every time they make a deal, the people that are in charge there, they either break it or they want to change it. So it looks like they're not ready to make a deal. So they're going to continue to pay a price. And every night the price gets higher and higher and higher.
Secretary of State Marco Rubio speaking to reporters there in Manila as the US and Iran exchange strikes for a 12th consecutive day. And this all, of course, as the Houthis attack 2 ships in the Red Sea, jeopardizing another key shipping route. Bloomberg government's Mika Solner joins us from Washington. The cost of the Iran war is growing and growing exponentially at this point. Mika, is there any sign that the Trump administration is concerned about that?
I mean, yes, definitely. I mean, I think that we saw the president yesterday attend the dignified transfer of 4 U.S. soldiers that were killed as a result of Iranian strikes in this war. And I think that this is really escalating these tensions now between Tehran and Washington. And it doesn't seem like there's going to be any more negotiations happening soon. I mean, we saw the president's earlier warnings this week that he said that he's prepared to potentially hit civilian sites such as bridges, including ones near the capital city of Tehran. Now, of course, the president has made these warnings before, but it just shows the escalation in rhetoric and the approach that the Trump administration is making here.
What about this Silicon Valley Bank investigation? Is the Trump administration targeting Fed Governor Michael Barr? Does the administration want him removed from the board?
Yeah, I think this is one of those cases, I think, where, the administration tends to escalate its looks into these kind of things. I mean, this is something that they've done before in terms of trying to kind of set those warnings for people and against the Fed in general. So we're going to have to see what comes out of this.
What about congressional stock purchases? Mika, that's another story emanating out of Washington. Objections from Democrats, obviously, to an unrelated provision in the legislation. But will it end up passing?
Well, I think it's really difficult to say right now. Right now, I think it's very unlikely just because of the voting provision that was attached to this congressional stock ban. I mean, I spoke with a lead Democrat, Seth Magaziner, for example, of Rhode Island, who said that, this is not a serious approach to an issue which has, over 90% of support publicly, very high levels of support, and a broad support across Congress. So this is a very popular bipartisan issue, a rare one in Congress. The president has signed on. The House Minority Leader Hakeem Jeffries, of course, is supportive of some kind of ban, and Speaker Mike Johnson in the past has expressed support for it too. So this has support in Congress. I think it's whether or not those provisions that are added and how lawmakers really want to get this through.
All right, Mika, thank you so much. All the roundup from Washington, D.C. That's Mika Solner from Bloomberg Government. Back to earnings now. Alphabet lower in the pre-market after reigniting investor concerns over outsized AI spending. The firm forecasting as much as $205 billion of it this year. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, we were expecting that they would increase their forecast, but they didn't increase it by so much, and yet the market did seem to sell off. What's the market saying?
Well, they didn't give us any numbers for 2027, so this is just for 2026. The capex numbers went up by about 4 to 5%. But look, overall, I think what they are suggesting is next year probably is going to be another 50% type of growth in capex. So that will take them to somewhere around 300 billion. Even though they didn't guide to it, I think the fact that they are talking about high, growth in the cloud segment, driven by the TPU system sales, which is a new segment within their cloud, and they want to invest in that. And I think they have the balance sheet to do it. So it's the knee-jerk reaction is obviously, more capex means negative free cash flow. But at the end of the day, they have the balance sheet to do it at a lot bigger scale than a lot of other players. And I think that's what they're going ahead with.
Mandeep, they're all in. Is there any inkling of doubt there, or were there any answers to analysts' questions that may have given us some kind of light on why they think that this is worth spending that much money on and continuing to increase spending?
I mean, just look at the cloud business. This business used to grow at 25, 30%. This quarter, cloud segment grew 82% with margins almost doubling to about 36%. Now,
There were some comments that margins will go down in the near term for the cloud because of the third-party compute rentals and the fact that they're investing in these TPU systems. But overall, it is a margin expansion story on the cloud side, which was a much smaller business. And you're seeing that type of growth, for a $100 billion segment growing at 80%. That's phenomenal. And I think that's where, yes, we can focus on the free cash flow going negative and the CapEx numbers going up, but they are showing that in the top line growth. And that's where, if you parse through the numbers, it's pretty obvious that a bulk of the growth going forward is going to be driven by cloud. It's not going to be any other segments within Alphabet.
Mandeep, what is Intel supposed to say to us later that will satisfy the investing community?
I mean, what we heard from Alphabet is everyone right now is investing in agentic infrastructure. So Intel should get a piece of that, given, CPUs are a lot more important for agent workloads where, in the training phase, we just needed GPUs. Now we need a lot more CPUs, and Intel still has a sizable share in that market. So from that perspective, I do see a path to double-digit growth for a company like Intel, which really was beaten up for a very long time. But it seems like the trends are aligning for them. And the other thing is the foundry business. They are looking to land up more external customers. So there'll be more to come on that front as well.
The stock just this year alone up an incredible 180%. And that's not even figuring the year-over-year number. Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. And do tune into our interview with the Intel CEO. That's going to take place at 11:30 a.m. Eastern. Coming up, we'll get you set up for your trading day. More earnings and the ECB decision, of course, on deck. This is Bloomberg.
Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. First up, your ECB rate decision. That's coming at 8:15 Eastern. And that followed by President Lagarde's news conference at 8:45. Not expecting a move, but at the same time, there will be interesting comments from Christine Lagarde on her tenure as well. Then we get more earnings from Lockheed Martin and American Airlines before the opening bell. Of course, the big one, Intel, after the market close. And Bloomberg's UN Secretary General candidate town hall takes place. That'll be live from the UN headquarters at 5 p.m. Eastern. Let's take a look at some movers pre-market this morning. We have to check out Alphabet. It said it was going to increase its spending this year to $205 billion, up about $10 billion from a previous forecast. Now, as Mandeep Singh just told us, they didn't give us the 2027 forecast. Alphabet shares are lower in the pre-market. Tesla down almost 6%. Efficiency in terms of capex spending is what investors are concerned about here. Profits sliding as well as spending climbs. And then ServiceNow, well, it was a better story for ServiceNow. Strong subscription growth overall, a really good number from ServiceNow. And perhaps that wasn't anticipated by the market, and so the market is rewarding that company. Let's take a look at your macro picture going into another huge day of trading. We have Brent crude just above $98 a barrel, continuing to escalate, and that is not helping with the tone, but also we have NASDAQ futures lower just generally because of the tech tone, and 30-year yields above 516 right now. Alarming auction yesterday.